Stocks are setting up for the fifth straight weekly gain as investors bet on future rate cuts from the Fed. But our next guest says that for the bull market to continue, other stocks must catch up to the Magnificent Seven. Dana D'Auria, who is the Investment Co-Chief Investment Officer, joins us now. Great to have you here with us this morning. First and foremost, what would be the catalyst for the rest of the non-Magnificent Seven to catch up with the type of fervor that we've seen for those names?
Yeah, thank you for having me. I think, well, we're in it, right? The Fed coming out with such a dovish series of remarks, and of course the market completely overshot on what was actually said. Now pricing in 6 rate cuts, and all of that is meant to happen not because there's a recession. We're still pricing in kind of this soft landing as well as these rate cuts. So I think that does it, right? And that's why we're seeing all of a sudden these stocks that hadn't been participating through the course of the year starting to catch up lately, because a lot of that too, some insight is, looking at just what was happening through the course of the year with large growth versus small growth. Seeing about higher rates theoretically impact growth stocks because they mean that they have to discount future cash flows for all those, future earnings. But we saw that far more happening with small growth, where they're probably not cash funded. They have to rely on capital markets more. So now with expectation of rate cuts, all of a sudden you're seeing those stocks participate. So I think we're experiencing it, but it is pricing in a very rosy scenario.
Dana, when you take into account this rosy scenario, what seems to be really driving the market's momentum between now and the end of the year, looking ahead to maybe some of those risks that linger outside of the fact if we don't see the participation from more of those stocks outside the Magnificent Seven, what's on top of your radar?
I think timing, right? And just, kind of the way that these things play out historically. It doesn't jive really with kind of behavioral finance, I guess, right? And what people see when they look at the current market. But really, it's not atypical for unemployment to be low at this stage in a cycle. It's not atypical that, there's kind of this complacence to a certain extent after, the rate hiking cycle that we've had. These things, impact the economy at a lag. So a lot of companies termed out their debt, and they haven't had to go back to capital markets yet at these higher rates. But that's coming. We know it's coming. And in spite of, maybe money supply not being terribly restrictive from a historical perspective, it's more restrictive for sure than it was. So I think, it's just that lagged effect of a lot of what's already happened coming into the market.
What would need to happen for the Magnificent Seven to see that kind of next leg higher here? Because I think for all of what has transitioned in the hype phase and now into the show me story for a lot of the generative AI kind of fodder of the conversation and so forth, 2024, it seems like there's going to need to be delivery, maintenance of, and continuity for a lot of that sentiment to prevail and push these stocks even higher.
I completely agree in your comments earlier in your broadcast. I mean, I think, the problem with AI is that the expectation that it's suddenly going to massively increase productivity, I think, is putting a lot of expectation on something that is, at the end of the day, relatively new. Most companies don't yet know how they're going to make benefits from AI, even if the benefits are possible, right? So, markets are short-term in nature, and if we're pricing in, particularly into the Magnificent Seven, an expectation and, right, the NVIDIAs of the world, if we're pricing in an expectation that the AI boom happens sort of next year in terms of actually see, the economics, the corporate finance aspect of things, I think it's a lot to expect, and again, you're pricing a very rosy scenario in there. That's not to say that the long run potential of this technology is not massive. It's just, the expectation of markets for it to happen so quickly.
So, Dana, if you do expect to see a broadening out here in terms of participation, where do you expect that leadership to come from?
I think, as I say, the beaten down stocks, these small cap companies that, hadn't participated, and just, massive gap between what you were seeing in the large cap growth, for example, and small cap growth. I think now there's some catching up that happens with that. And I largely tend to advocate, just because if you're a long-term investor in the market, which, our clients are meant to be, then you're thinking in terms of what's my long-run expected return potential. I tend to advocate for, a tilt towards small value. It's not a prediction that it's going to pop in 10 minutes, but that you get some bang for your buck. I mean, it's kind of a basic tenet of finance that if you buy low, you have a higher expected return in the kind of medium term space. So I think there's opportunity there for sure. And certainly if you've been really focused and concentrated in the Magnificent Seven, or even market cap weighted, where you're getting a massive amount of Magnificent Seven, whether you ask for it or not, tilting towards some of those smaller, more value stocks. And these stocks as well have the added benefit that, they tend to outperform inflation over time. If you just look historically, and, inflation's looking great right now, right? But inflation tends to come in waves, and it's very difficult to say for sure that, we've really put the nail in the coffin on that.
Yeah, it certainly has, and we heard that reflected a bit from Jay Powell on Wednesday. Well, Dana Diorio, great to have you here, Envestnet Co-Chief Investment Officer. Thanks, Dana.